Aye. Anyone? Steve, I'll ask you to do introduction of guests from the city and or FFE.
Okay, so again, we have Clyde Robinson, City Attorney, Mayor David Anderson. We have Steve Brown, the Foundation for Excellence Manager at the city, and we have Alyssa Carroll, who is the new treasurer for the FFE. I think
Okay.
I've covered everyone.
Great, thank you, Steve. Chris, could you do introduction of guests from Marion and Zhang, please? And Chris, you're muted. Chris, you're muted.
Hi, I've got Katie, Richards, Lindsay, and I was looking for Rob. I haven't seen him yet.
Yeah, Rob's there.
Okay, then we're good.
Okay.
Rob McDougall.
Okay, thank you. I'll go to review and approve the minutes of the May 26th meeting, which were included in your package. Can I have a motion to approve those minutes?
Move approval.
Support.
Motion support. Any corrections or discussion around the minutes? If not, all those in favor of approving the minutes as drafted signify by saying aye. Aye. Anyone opposed? Minutes are approved. Steve, can you show us in assets at June 30th, please?
Yes. Okay, so I put it up on the screen here. As of June 30th, we're invested in two funds, 53.3 million at BlackRock and 48.6 million at Jennison. Just like to note that we're still within our 3% threshold, so there was no liquidation or rebalancing necessary this quarter.
Okay, before you leave that page, let's talk about the development since June 30th. So I think everyone is aware that there was the great announcement about a 400 million contribution over 10 years. And Steve, I think we've received the first payment of that. Can you give us an update of that, please?
Yes, we have. We received the first payment. Let me pull up my dates here. It was just over a week ago. Sorry. And that payment's been liquidated. We received right around 39 million and net of fees and liquidation. The funds came in just above 38 million. I'm trying to pull up my exact dates here. I had this all ready to go earlier. Okay, so just to bring in the actual numbers here. So we received the first contribution. It came in at a mean price of $38.6 million on August 12th. We were able to sell between August 16th and August 18th for a net total of 39.5 million. And those have now been added and invested into the funds that were presented there, and we rebalanced the funds to a 50-50 upon that deposit.
Okay, so that's an important.
Any questions on that?
Yeah, I was going to say that's an important issue because as I sent around the communication a few days ago, we are going to want to talk about asset allocation. And so it's important to realize now that we have our first $40 million close to $40 million contribution out of that 400. So just keep that in mind as we go through our discussion in a few moments. Let's move to investment performance. Rob, and can we move along that fairly quickly, please?
Yeah, definitely will. So the fund, the balance at the end of the quarter was 102.1 million. The net increase during the quarter on investments was 5.08. Again, it is a 50-50 portfolio, but equities were up to 52.3, as Steve had mentioned. Equity during the quarter was up 8.54. Fixed income during the quarter was up 1.54. So the inflation adjusted return during the quarter was a positive 2.5%. Next page, Steve. Pie chart again, this is before the rebalance. So equities doing better, representing 52.3%. We have talked about Jennison during all the conversations. Just to point out here, they were slightly below their benchmark during the quarter, 32 basis points. Without going into their full report, they were overweight 7-year treasuries, which underperformed, and they were underweight 10-year treasuries, which outperformed, which represented almost the entire 32 basis point shortfall. They are currently, you can see the allocations here in the middle of the page towards the bottom. They're overweight treasuries, dramatically underweight mortgages. That's where they expect to stay. They are overweight credit at this point, but they point out that right now that the credit spreads are as tight as they've been since 2005, which was just before the housing crisis. And so they're sort of on alert here, and they're suggesting that if the Fed continues to be as accommodative as they have been, they're going to start to reduce that underweight in credit. Their overall view on the market is that with the credit spreads where they're at right now, you're not getting paid, taking higher risk. So they're moving towards higher credit in all three categories. Next page, simply the graph showing up in the quarter 5.08, graph on the next page as well. The following page, Steve, if you can keep up with me, sorry, simply showing the allocations and the variance there. The next page shows the year-to-date return on S&P 500 at 15.24, fixed income under by 2.09%. Again, we've talked about Jennison in all the meetings, satisfied with where they're at, just 1/4 of underperformance here. The next quarter, or the next page, Steve, simply shows the fact that in terms of the composite benchmark, the two that we have components, we were 1 basis basically in line with it on the S&P 500, Jennison down a little bit, and on a year-to-date basis, the same holds. Next page shows that the composite benchmark, the performance was slightly below. Again, that's because of the Genesis underperforming by about 30 basis points. We can go through the benchmarks. Those are accurate, or the best representation that we should be using. And that is it on the investment side. I know I went really quick, but it is a pretty simple portfolio and not a lot of variance from the composite benchmark. Does anyone have questions?
Any questions or comments for Rob? Okay, I guess I'm hearing none. So Steve, let's deal with review of expenses.
Okay. So just kind of covering through really quickly here, we had our annual audit and 990 fees, on pace with consulting fees. Again, state street fees, generally maintaining, tracking with the overall value of assets. They're obviously still behind on their billing. We're only paid up through December. So there's still some work to be done on their end on that, but I won't complain about it. And then continuing, we have BlackRock and Jennison, again, tracking per their norms, again, in line with the overall value of the portfolio. So for total expenses of $105,000. So I would request approval for $105,362.
Could I have a motion to approve those expenses?
So moved.
Support.
Motion and support. Any discussion? Hearing none. Steve, could we do a roll call, please?
Sure. Sorry, I lost my sheet. Nick Griffith,
Yes.
Joshua Sledge,
Yes.
Dan DeMint,
Yes.
Dean Berge,
Yes.
Randy Eberts,
Yes.
and Bob Salisbury.
Yes, motion's approved. Thank you. So I'm going to deal with the next few items on an exception basis. So communications, due diligence, all the items that are under those two sections, they were all included in your package. Are there any committee members that want to make any comments or have any questions about any of those items?
And I'm getting kind of bugged about.
Hey, Bob.
Yeah, could you?
Can we mute Dan? And did we want to review the cash flow? I know it's pretty straightforward at the expenses.
Okay, yeah, I'm sorry, Steve, I did jump ahead. So first of all, can you mute Dan, Steve? Because I think.
There we go.
Okay.
Yep, we got him.
Okay, so I'm sorry I skipped cash flow. Let's do cash flow, please.
Okay, so pretty straightforward. We were able to bring in some other donations of 52,000 into the fund, and those were, and then a net disbursement of 76,000. And again, just covering the beginning investment balance of 97 million, increasing to the 102 million that we're at today. So again, not terribly complicated given where we're at with the fund today.
Okay.
Steve, do you expect another 1.5 million or so in gifts to kind of satisfy this year's pledge?
For this year, I'll leave that to Steve Brown if he wants to make any comment on that. I know that situation's currently still in process. There's always a little bit of difference between when the gift is planned and when it actually gets transferred and what those stock prices do in any given day. So Steve Brown, I don't know if you want to cover it in any further detail than what I just did.
Thanks, Steve V. This is Steve Brown here. We're going to look into that. The pledge is clear in its language about assets or cash in the value of, and it's got a buy date of December of each year. So we'll look into that, but I can't give you a concrete answer right now.
Right. Thank you.
Yeah, so the actual proceeds that we received, I think, Steve, were 39.5 million is what we realized, whereas the contribution date was 38 something, right?
Correct.
Yeah. Okay, so now I'll try to
Bob, just
Yes.
one quick question
Yeah.
for Steve. On the cash flow, you mentioned something about AARP grant. Is that right? Is that for the aspirational bucket?
No, I didn't mention anything about that.
Well, I thought on
there's
your
nothing
on the sheet that you sent us earlier.
on the 10-year funding.
Yeah, right. That 10-year funding sheet.
Okay.
Anyway,
yeah, so I can clarify that here real quick. On that funding projection, we were projecting less aspirational spend, as the city is also going to be spending $40 million from the American Rescue Plan stimulus funding.
Okay.
So because those buckets align, there's a lot of overlap between those two buckets, that we do anticipate, that there's only so much capacity that the city can handle at one
Sure.
time, and that for the next couple of years that'll be a little bit less than what we would normally anticipate.
Okay, thank you. Sorry, Bob,
Okay.
go ahead.
No, that's fine, Randy. Any other questions for Steve on cash flows? All right, let's see. Are there any issues under communications or due diligence, education, governance, which committee members feel are pressing we should discuss at this point? I see a lot of not shaking of heads, so I'll assume there's none. So I think the very important discussion that we have to have is, given the latest development about the FFE, the 400 million pledge, the money that we have already received, what should we be doing, if anything, about asset allocation? And committee members are aware that I sent out a note to all of the committee members, including Steve, just to lay out what I thought were the issues. And the important portion of it is starting with the 10-year cash flow that Steve had provided to us. And I think the important thing that this cash flow shows is that in the period covered by the forecast, which goes out 10 years, is that there's no expectation that the current balance of the portfolio, it has to be used to cover the needs of the FFE. That the 2-year funding commitment for the year 2021 and 2022 is covered by a separate agreement, plus the annual contributions, the remaining annual contributions of 40 million a year, will be more than enough to cover the annual spending requirements of the FFE. So the assumption that I came to when reviewing those cash forecasts is that the corpus of the fund, as we would call it, the 100 million that we had almost to begin with, plus the first 40 million contribution, is not going to be needed for the foreseeable future. And Steve, can you confirm that that's a reasonable conclusion for me to reach from that?
Yes, I would completely agree with that.
Okay. And any other committee members want to disagree with that point, having reviewed the cash flow forecast?
And not a disagreement, Bob, but curious just while we're talking, the requirements that were modeled out there, is there any chance that those will change as the size of the endowment grows? It looks like, we're kind of projecting to get from, I think it looks like almost 10% of the amount of the endowment each year being, released in contributions to about 6. Is that just kind of the natural flow where we'd want to get to make sure that the endowment is stable for the future? Just kind of wondering where those requirements come from and if there's any possibility that they may change in the projected timeline.
Sure, I can answer that. So the requirements of the budget stabilization payment are fairly well set. They're set by the bylaws of the FFE. The tax reimbursement also, will not perfect. It will never be perfect based on a projection. Should be pretty steady with what we projected out, as that is set in the bylaws to fund the difference between the 19 mills and the 12 mills that we are currently charging for property taxes within the city. The one bucket that may change from year to year would be the aspirational funding. We've typically tracked at spending a little over 8 million per year since we've started that fund. That's not to say that there may not be a down year or may not be a year where we have a bigger spend or a larger project that we want to complete. But that would all be well communicated ahead of time, as the FFE is required to pass its annual request in October of each year, and then make that funding available out of the endowment starting February in the subsequent year. So Steve, I don't know if you want to add anything further to that.
Not at this time. No, thanks, Steve.
Yeah, so my understanding is that unlike an endowment where you come up with a spend based upon, like a percentage of the corpus of the fund, the FFE is really driven by a budgeting process from the tax and the other buckets that you have. So it's quite different from a more traditional endowment fund. Is that a correct understanding?
Steve Brown here.
I would agree with that.
Yeah, I'd agree with that. There is a required minimum distribution of 3.5, which is different from the typical 5% you'd see for private or other community foundations. But it's whichever is greater, and the annual liabilities that we have really track to always be significantly more than the 3.5%. So we'd be based on the thinking that Steve V just laid out, as opposed to a flat percentage formula, probably really forever. So consistent, absolutely.
Got it.
Okay. So, does that cover your question, Josh? Yeah. Sorry.
Yeah. So I just wanted it sounds like the aspirational projects. I mean, the big thing when I was kind of reviewing about, I think, what you said out makes a ton of sense. And this is the only kind of area I was wondering was, with that commitment, is there an expectation that more money is going to be distributed towards the goals of the fund, right? Or is it more that contribution is just about kind of stabilizing the endowment for the future, but we don't expect any additional, especially in that kind of aspirational projects bucket, any additional spend going forward?
Thanks, Josh. This is Steve Brown again. It's been discussed as a maximum of $10 million per year, and that's the way that we conceive of it. The spend has been, as Steve V said, on average about $8.25–8.5 million per year, and we would anticipate that to continue and then never breach $10 million. There are provisions available for using corpus dollars in the occasion of a major capital investment, but those are really only notional. Those are provided for in the bylaws, but those have never been active discussion, and certainly would be require a tremendous amount of discussion and preparation for those to even be considered. There'd also be other tools at our disposal as opposed to ever dipping into the corpus. So we should be very predictable in those three areas, budget stabilization, tax lowering, and then even the aspirational.
Terrific. No, that's helpful, especially as we think about, cash flow contributions in the future and what that means for investment policy. Helpful explanation there. Thank you.
Super.
Okay, thank you.
Yeah, Bob,
Sorry.
Can I just pick up on what Josh was saying? I saw the final year of your 10-year projection, Steve, that this is Steve Vincenzi, that it was about 6.3% of the corpus that we would accumulated by then, according to your estimates. And so we're actually above the 5% by a significant amount, maybe, because 5% is 25 million off of a 500 million endowment. Yeah, is that what we should be
Yeah.
anticipating at that time?
I would say that would be an accurate projection right now.
Yeah, so I think really what happens when you get out to that point in time, that percentage draw is going to be driven an awful lot by investment results throughout this time frame. So Steve made certain assumptions as to what the investment results would be. And the only thing I can assure you is that his assumptions are going to be wrong. I just don't know which way they're going to go. And so, you know, there will be adjustments, but I think it's an understanding that for at least 10 years, the cash flows coming into the fund are going to be sufficient to cover the spending requirements. And so maybe the goal for us is to try to maximize the return on a corpus that's not being used for that purpose, so that you can then have a pool of assets that might contribute longer to the future of the FFE. And that's really what was leading into the next point of my discussion, because at least from when I review these numbers, I come to the conclusion that a 50-50 existing asset allocation is probably too conservative for the fund. And so I'd like to ask the question of committee members, do you agree or disagree with that conclusion?
I agree with it, Bob.
Dan, you're muted.
Yeah, sorry, Dan, we muted you when you were on the phone.
Okay. No, I just wanted to confirm that the recent payment that has been made has already been committed to the market.
As Steve said, it was put into the 50-50 allocation.
Yes, I understand.
Okay, so I hear violent agreement with me that that a 50-50 asset allocation is probably too conservative. And as some of you, if you'll remember from the communication that I sent over the weekend, I laid out just 3 straw man alternatives for us to consider. And I'll make it simple. Rather than talking about 3, I'll talk about 2. One is we go to a 75-25-5 allocation, as we currently have for the city pension fund. Or 2 is we go to a more conservative allocation. I came up with a number of, say, roughly 65-35. Which takes into account the fact that the stock market is at very high valuations, and this might not be the best time to move us into a more fully aggressive allocation. So just thinking about those 2 alternatives, I'd like to hear how the committee feels about moving in the direction of one of those two alternatives. Maybe I'll ask Dean to go first because you're unmuted.
So I was unmuted because I was going to just ask one point of clarification on the assumptions that we've made, but then I'm happy to also dive into your, Steve, on the assumptions you made. You said investment return under 300 million, 6.5%, and over 300 million, 7.5%. Is that the total corpus when it breaches 300 million, or are you saying the first 300 million that's invested is going to be 6.5, and then anything over 300 is 7.5? Just so I understand what assumptions we're looking at.
Yep. So that was largely, once we hit 300 million, I assumed the 7.5, and that was based on previous discussions in this group that originally we discussed moving to a different asset allocation when we hit 300 million. But now circumstances have significantly changed that allow us to have the discussion we're having today.
Okay, so just to clarify, once the total number moves past 300 million, you're assuming 7.5 on every dollar in there, or just in dollars over 300 million?
On every dollar. So as I look at my projection, it would be in the year starting 2027.
Okay. Yeah, I think that obviously begs Bob's question to some degree, is if we're making those assumptions, I think we're begging the question that we're moving to a different asset allocation. So Bob, I appreciate the way you framed the question. You know, I'm not a market timer. I think we ultimately need to end up, you know, in whatever, and again, I know overall we're talking about, you know, in the overall context of discussions we've had as a committee, we're talking about, you know, maybe making some tweaks to what we do with the allocation of assets. But I think it makes sense that ultimately we would end up, you know, at an allocation that is, you know, matches to a large degree what we're doing with the other ones, to the extent we're trying to maximize total return. So that would say to me that ultimately we need to end up at, you know, this 70-25-5 or something in that ballpark. I am a little bit concerned about how quickly we move there. So, you know, and again, I don't, maybe I feel like maybe this sounds like I'm just hedging the bet, but it seems like maybe we ought to move there kind of as the funds come in. And some of that is just thinking about dollar cost averaging as we move away. So I guess, Bob, again, I'm not trying to dodge your question, but I think we ultimately need to get to the full allocation the way we've done it with the other funds generally, but I think we might want to do that in a step basis.
Can I jump in for just a second here to sort of piggyback on what you were talking about, Dean? One of the reasons I asked about if the funds have been committed, I don't have a feel for, but I'm sure there are transactional costs every time we move into or out of one of the funds. I'm sure that's true.
I tell you, they're probably relatively small because they're index funds, Dan. Very, very small.
Well, so what I was thinking about where Dean was coming from, if we make a decision that we're going to make changes today, we're going to incur some fees. Where if we make the decision like the 75-25-5 to apply to additional receipts, could we avoid some of those transactional costs? And maybe it's not worth worrying about. I just don't know.
Well, possibly, Dan, but you know, we'll have to wait a year before we get the next 40 million to do that.
I understand.
Yeah, this is Chris. You're not going to have that many transactions if you're going to get donations once a year, and you're not going to make withdrawals for another 3 years. And even when you do, you only take it out once. So that once per year. So it's not going to be a continuing transactional cost. There'll be 2 or 3 transactions per year.
So, but just to think about the practical aspects, let's say that we're at 50-50 with a whole 140 million today, and we wanted to move to 70-25-5. What it really would mean is we'd have to take some money out of Jennison and move it into the S&P 500 index fund and maybe move it into a Vanguard REIT. I think taking money out of Jennison, they don't charge us a transaction fee, and putting money into an S&P 500 index fund or putting money into a Vanguard REIT doesn't have any transaction costs. So, Chris, correct me if I'm wrong, but I think essentially the transaction costs are a non-issue in making a move like that.
Yeah, particularly under those circumstances and the number of times we do it. People get transaction costs beaten up by doing trades daily or weekly or monthly. So we're not going to do them that often. And they're cheap.
Yeah, my concern was making the change now, but if there's no charge on part of Jennison, then my position would change a little bit, and I would probably think that we should move ahead at the present time.
Okay, thank you for your comments, Dan and Dean. Maybe I'll go to Randy next. What are your thoughts?
Well, I agree that we need to increase the allocation to equities. And, you know, 70-25-5 is something that we're very used to, and we know what, you know, how to deal with that. So I think we should get close to that. I'm not quite sure if, you know, I'm not a market timer either, as Dean just said, but I think that, you know, there's going to be times when the market's going to go up, it's going to go down, but if we don't get in there, we're not going to have any of the upside of this, you know, the market going forward.
Thanks, Randy. Nick, how about you? Some thoughts?
Yeah, I have a few thoughts. And as I looked at the funding projections out through 2035, I think is as far out as it goes. What it's looking like is distributions from the endowment project to be over 6% per year. And I know we're not looking at it as a percentage, It's more of a dollar amount, but that's basically what it comes down to. So that's a little more aggressive than a lot of times what we see with traditional endowments and foundations. Plus, we want to factor in inflation. So I think that what that tells us is we need a fairly risky asset allocation to achieve those goals. So given that, I would be supportive of the 70-25-5 that we're accustomed to.
Okay, thank you, Nick. Josh, how about you?
Yeah, likewise. I mean, I think, making a move to shift more towards equity makes sense. 70, 25-5, like Randy and Nick mentioned, are things that, it's a allocation we're familiar with and I've seen to be pretty useful for the pension funds. I think in terms of if we do it now or in the future, I mean, I think we should make the transition. I'd say let's make it forward in terms of how we want to do that and with transactions and everything to make sure we're optimizing and reducing risk. This is where I'll turn to, Chris and Rob to help us, run the numbers and just kind of figure out what's the optimized way to structure those. But I'd be in favor of shifting to that 70-25-5 allocation, moving forward with whichever way is most prudent.
Thank you, Josh. I'll also tell you that I had a discussion yesterday with Sandy after I knew that she couldn't attend the meeting. And I'll tell you that Sandy was very strongly in favor of moving immediately to the 70-25-5. She thought that my approach of just putting this year's contribution into equities, which would put us to about 65-35, was just delaying the question. If you really believe that 75-25-5 is the best long-term allocation, that we should move forward with that. So based upon that discussion, it sounds like we are at a consensus that we would want to move as quickly as is reasonable to a 70-25-5. Is that appropriate consensus?
Yes.
I don't see anybody shaking their head. And before I do a motion, I want to carry it into a little step further. One choice of doing this would be to actually do the actual allocation that we have for the city pension fund, where we include not only the S&P 500 index fund, but we have the various DFA funds. And the question is, at this point in time, do we want to do that allocation, or do we, as I suggested in my communication over the weekend, do we want to consider just a simple move it into the S&P 500 index fund and use that as a placeholder, given that we are doing a reevaluation of our asset mix for the other funds and would probably want to follow a similar asset mix once we reach that decision. So can I just do a quick go around and ask which is the preference in terms of moving there? Is it the full allocation, which includes the DFA funds, or is it just a S&P 500 index fund? Randy, I'll start with you.
Well, I mentioned to you, Bob, in an email response that I'd like to keep the two decisions separate. And so if we can do that, I was thinking more of a simpler approach, like S&P index of some kind for the 70-25-5, instead of having all the different DFA funds and everything else. But I don't know. I guess I'm just a little leery of getting right into all the issues of small, large, the asset allocations that we're getting going to think about going forward. So anyway, that was my approach. The first decision is keep the two decisions separate. The second one is let's keep it somewhat simple as we go forward to the 70-25-5.
Okay, thank you, Randy. Dean?
Sorry. Yeah, I would be fine with that, Bob. I mean, I think, we've had a lot of discussion and, we do believe that, we've believed over time that the DFA approach does make sense, but I'm okay on a step basis, starting with just the more simple approach. And, I mean, it's really, where we're getting bang for the buck over time as being more in equity. So I'm okay proceeding in that fashion to start.
Okay, Dan?
Yes, I would agree with going just to the index fund for our equities right now. I think it's obvious that we're going to have continued conversations about allocation. And so rather than get DFA in the mix at this time, which might well change, 3 months from now, a year from now, I like the simplicity approach about going to the index fund for the 70%.
Okay, Nick?
I'm comfortable with the simple approach, but before we went around the table here, I was leaning towards proposing the DFA approach simply because, as we've acknowledged, valuations are high. Any way to soften that would be to take a value tilt at this point where valuations are slightly more attractive. But with that being said, I'm comfortable keeping it simple for now. Just wanted to throw that out there.
Yeah, good point. Thank you. Josh, how do you feel?
Yeah, no, everybody I think has laid it out very well. So in agreement of making the move there.
Okay, I'm going to ask Chris and Rob, you see which way we're heading. Do you have any reason to think that we shouldn't go on that approach?
This is Chris. No, that's very reasonable. The question I have is, do we want to use more than one manager or just the three basic managers and then maybe use multiple managers in the future?
Well, I think, Chris, I think what we're saying is, I think I'm hearing a consensus that right now it's just a single equity manager for the 70%, which would be the S&P 500, and put the 5% in the Vanguard REIT.
The Vanguard REIT, okay. And the other would be Jennison.
Yep.
And no international exposure then?
Not at this point. Rob?
Yeah, Bob, the one thing I would throw in, it ties to Nick certainly, is you're talking about only the S&P 500. So if we're talking about valuations, those actually are kind of stretched. One alternative might be DFA's Core Equity 1 or Core Equity 2, which is the entire market, and it does tilt to small in value. Just to throw that out there, that's an alternative. Or maybe another alternative is just Vanguard's total market, which doesn't have that small in value bias, but does have mid cap of exposure of about 20% and 8% small cap.
Those are interesting ideas. I think, okay, so I think, Rob, you just introduced a very interesting concept for us. One of the challenges that we have is that I wouldn't feel comfortable making a move into those until we have much more information available to the committee members that we know exactly what we're saying. I know a little bit about the DFA core fund and everything else, but I think we need to deal with something that we know a great deal about at this point in time as a committee. Maybe when we come back, we might decide to have a special meeting, or maybe when we come back in December and we've got more information from our asset allocation fund, that we could make some changes at that point in time. But I think given where we are today, that it's probably important that we make a decision. And given the knowledge that we have, I don't want to stretch us too far without having done our homework very carefully. So with all of that, I am going to make a motion and see if we can have a second. And then I'm going to try to get us to have a unanimous approval, because that's been our rules in the past about important decisions. I'm not trying to strong arm anybody here, but I think, I think we need to get to a decision point, but I'd like us to be comfortable with what we're doing. My motion is that we change the asset allocation to 70% in the BlackRock S&P 500 Index Fund, 25% in the Jennison Intermediate Bond Fund, 5% in the Vanguard Real Estate Index Fund, that we make that allocation as soon as possible, but that we're prepared to make changes in the future with more information and as we do more work on our asset allocation study. So that's my motion at this point in time. Is anybody willing to second that motion?
I am. I second it.
Second from Randy.
Yep.
Thank you. So I'll open it up for discussion among committee members since we have a motion and a second. Gee, it sounds very quiet. So Steve, could we have a roll call on that motion, please?
Yep. Nick Griffith,
Yes.
Joshua Sledge,
Yes.
Dan Dement,
Yes,
Dean Berge,
Yes.
Randy Eberts,
Yes.
and Bob Salisbury.
Yes. So the motion is passed unanimously. And so thank you very much. And Chris and Rob, I guess it's your job to work with Steve on the implementation of that.
We can do that. And this will make it really quite easy because you've got the basis. If we want to take some quick allocation studies with Rob's suggestions, we could send those to you, but we will be invested in the meantime. We will not be sitting idle.
We will be invested. Let's get the information. Let's have some offline conversation. If we have to have a special meeting to make some change, we can go through the process of getting a special meeting. But I think we've reached a good point at this point in time for our committee having made this decision. Before I move on, any further on asset allocation? Hearing none. How about insurance? Anything to report there, Steve or Clyde?
I can give you a quick update. Obviously, since insurance's biggest issue has been, we're a foundation that was anticipating having a $500 million endowment. And how do they how do they protect something that's not built yet? Now with the public commitment that has been made and the first deposit, we've been able to reopen discussions with a number of those insurers. So obviously that didn't happen all that long ago, and hopefully by our next meeting, I'll be able to have some insurance be bound for us.
Great, thank you. Next item on the agenda is public comment. Steve, can you handle that, please, or is that Steve Brown?
Sure. One of our IT people, I believe it's Andy. Is there anybody public comment?
Yeah, this is Don. Yeah,
Don.
Currently there's no public comments at this time.
Great, thank you. Future meetings are noted on the agenda, or with our next meeting December 1st. And if we decide that we need to have a special meeting, we'll do so. I'll do an around the table. I have nothing. Randy, do you have anything?
Nothing. Thank
Dean?
you, Bob.
Nothing.
Dan?
nothing.
Nick?
Nothing.
Josh?
Nothing.
Steve Vicenzi?
Nothing.
Steve Brown?
Nothing except thanks to each of you for your service to our community in this way.
Thank you. David Anderson, anything? No, he's good. So I'll adjourn the meeting. Thank you all for your participation. We made an important decision here for the FFE, and hopefully it works out to our benefit. So goodbye, everyone.
Goodbye.
Take care.